Hi students, welcome back, and in this lecture I will be touching on 3 points. First of all, I will be talking about the formation of a corporation. Secondly, I will be talking about the rights of stockholders. And lastly, I will be talking about the stock issue considerations. So without further delay, let us start the discussion. First of all, I would like to talk about the formation of a corporation. So as you can see, there are three initial steps in forming a corporation. If the founder member of a company thinks that they want their company to get incorporated, the first thing that they need to do is to apply to the Secretary of State. Upon receipt of such application, the Secretary of State evaluates such application and they try to find out whether all the criteria that are required for a company to get incorporated are satisfied. Once they are satisfied with all the criteria, they grant a charter. So what is a charter? Charter is a legal document that describes the name, the purpose of the corporation, the type and the number of the shares of stocks that are authorized to be issued, the name of the individuals that formed the company, and the number of shares that these individuals agree to purchase. So all these things are clearly written in the charter so that there is no ambiguity whatsoever regarding these issues. So upon receipt of the charter, the company must make a bylaw. So bylaw is a document that states all the internal rules and regulations for conducting the affairs of the corporation. So this is also very important because this is the Bible for a company to follow for all their internal affairs. So students, I would also like to draw your attention on two other things which are very important to know. First of all, in the legal documents or in the law, there is nothing written like that. The companies need to be incorporated in the state where its headquarters is situated. So what happens is that companies generally get incorporated in a state where the laws are more favorable for their business. Secondly, the corporations which are engaged in interstate business, they must obtain a license from each of the states in which they're doing business with. So this is something that must be done apart from the initial three steps that has already been discussed. So this is how a corporation is formed, and these are the steps that must be followed by the corporations. Here I would like to draw your attention on the stockholders' right. So the first right that the stockholders have is the right to vote. So the stockholders can vote in electing the board of directors at the annual general meeting. They can also vote on actions that require stockholders' approval. So how does this voting right works? One vote represents one share. So if a person has 10 shares in the company, that means that person is eligible to give 10 votes on certain issues. So this is how it works. So the next right that the stockholders have is the right to receive dividend. Dividend is a portion of the current year's earning that the corporation distributes among the stockholders. So this is a portion of earnings that the stockholders are eligible to receive as income on their investment. The next right is called the preemptive right, which says that a corporation must inform the existing shareholders about any additional issue of shares before it is being communicated to the public. It is done in order to maintain the percentage of ownership right of the existing shareholders. So if an individual shareholder thinks that they want to maintain the existing shareholding in the company they can actually buy the new shares in order to maintain their ownership right or the voting right in the company. So let's consider an example. Let's consider that this is a person who is a owner or the shareholder of this company, and right at the moment she has 14% ownership right in the company. So according to the preemptive right, if a company issues additional 100 shares in addition to what it already has, then the company must inform her before it is being communicated to the general public. And if this specific stockholder thinks that she wants to have the 14% shareholding intact, then what she should do is that she should buy another 14 shares of the new issue and maintain this 14% in the future as well. So this is what this preemptive right gives to the stockholders. Next, we have the residual claim, which says that a shareholder will have the right to share in the assets upon the liquidation of the company. So in case a corporation goes for liquidation, what the company or the corporation needs to do is that first of all, it needs to liquidate all the assets that it has, and then first of all, it needs to pay off all its debts and claims that are there from the other stakeholders. So after paying all the claims and all the debts, if anything is left out, then only then the shareholders can get the share of the asset. And this is done according to the percentage of ownership that the shareholders have in the company. Here I will be talking about the things that must be considered by the corporation when the corporation issues stocks. When a corporation decides to issue stocks, it must answer the following three basic questions. These are: how many shares should it authorize for sale? How should it issue the stocks? What values should the corporation assign to the stocks? So all these three questions must be answered by the corporation before it issues stocks to the public. I will be talking about each of these questions and explaining how it should be done in the next few slides. Here I will be talking about the first question that we just saw. So the corporate charter indicates the amount of stocks that a corporation is authorized to issue. And how does a charter indicate this number? This is done by taking into consideration both the current need of capital and the forecasted need of capital for that specific company. The number of authorized shares is often reported in the stockholders' equity section. However, no formal accounting entry is required for that. Here I will be talking about the second question, which said how the stocks should be issued. So the stocks can be issued in two ways in case of a corporation. One is the direct method, where the corporation issues the stocks to the investors directly by themselves. And the second method is indirect method, where the corporation takes help from an investment banking firm in order to issue the shares to the public. So these investment banking firms are specialized in doing the issuance of stocks. They are specialized in bringing the stocks to the market, and sometimes it is done through the underwriting process. So I will not get into these terms in this course. So another thing that needs to be highlighted here is that when the corporation is a closely held one, direct method should be used. However, when the corporation is a publicly held company, it must use the indirect method, where they need to take help from the investment banking firms. Here I will be discussing on the third question, which said, what value should the corporation assign to the stocks? As you can see, there are two types of stocks in the corporation. One is called the per value stocks and the other is called the no per value stocks. So per value stocks are the capital stocks to which the charter has assigned a value per share, and in the earlier days this per value determined the legal capital per share that a company must retain in order to protect the right of the corporate creditors, and this portion of the legal capital was not available to the stockholders for withdrawal. So the stockholders could not withdraw this portion of the legal capital. So, however, as time went by, it was realized that par value has very little importance in the corporate world, because when the company issued the stocks in the market value of the stocks were far different from the par value of the stocks. As a consequence, many states nowadays do not require a par value. Rather, they go for no par value stocks, which is fairly common these days. And this no par value stocks is the stocks to which the charter has not assigned any value. However, in order to facilitate the recording process, the board of directors assign a stated value to the no par value shares. So students, let us do an exercise here which says which of the following statement is false. So in A, we have ownership of common stock gives the owners a voting right. Definitely this is a true statement. In B, we have stockholders equity section begins with paid in capital. So that is also true. Then it says the authorization of capital stock does not result in formal accounting entry. This is also a true statement, because a little while ago we just said that authorized capital has no accounting entry. And in D it is said that legal capital per share applies to per value stock but not to no par value stock. So this is definitely a false statement, because as we have discussed, shares can have par value or it can also have no par value. Whatever it is, it represents the legal capital of a corporation. So here you see the answer is D, which says legal capital per share applies to per value stock but not to no par value stock. So this is the false statement that we have among the 4 statements that are written. In order to brush up the concepts that has already been discussed, let us do another exercise. It says that indicate whether each of the following statement is true or false. If false, indicate how to correct the statement. So firstly, we have the statement that similar to partners in a partnership, stockholders of a corporation have unlimited liability. So this is definitely a false statement, and in the next slide we will see how to rectify this. It is relatively easy for a corporation to obtain capital through the issuance of stocks. Yes, this is a true statement which is mentioned in the advantage of a corporation that we have discussed in the characteristics. Thirdly, we have the separation of ownership and management is an advantage of the corporate form of business. So this is definitely a false statement, because we have discussed that this is actually a disadvantage of a corporate form of business, because this ownership and management being separate, it sometimes causes the owners not to be able to have control on certain managerial decisions that are not actually being taken to the best advantage or to the best benefit of the owners. So we will also be discussing on it in the next few slides. The journal entry to record the authorization of capital stock includes a credit to the appropriate capital stock account. So this is also not true, because as we have just discussed that authorization of capital does not require any journal entries. Lastly, all states require a par value per share of capital stock. So this is also not true because we have just said that there can be shares which may not carry a par value, and these are called the no par value shares. So as discussed in the previous slide, similar to partners in the partnership, stockholders of a corporation have unlimited liability. So this is a false statement. And how do we correct this statement? By writing the liability of stockholders is normally limited to their investment in the corporation. So this is how the statement can be rectified. Next, we have a true statement, so there is no need for us to rewrite it in order to correct it. So it said that it is relatively easy for a corporation to obtain capital through the issuance of stock, and this is absolutely right, and this is one of the advantage of a corporation. Third, we have the separation of ownership and management is an advantage of the corporate form of business. So we have said that this is actually a disadvantage. So how do we correct it? The separation of ownership and management is a disadvantage of the corporate form of business. So if we just write disadvantage instead of advantage, it will become a true statement. In number 4, we had the statement that the journal entry to record the authorization of capital stock includes a credit to the appropriate capital stock account. So this is actually again a false statement because we have just learned that the authorization of capital stock does not require any formal accounting entry. So this is how we are going to write it, and that will become a true statement. Lastly, we have all states require a par value per share for the capital stock. So this is also a false statement because we have learned that many states do not require par value stocks because there are stocks that are called no par value stocks, which means that no specific par value is assigned to this kind of stocks. Students, I have come to the end of this discussion, and if you can remember, I have touched on three major areas in this chapter. Firstly, I talked about the formation of corporation and the initial steps that must be followed. Then I talked about the rights of stockholders, and lastly, I talked about the stock issues consideration, where I have talked about the three basic issues that must be considered when a corporation is actually issuing the stocks. So in the next video, I will be talking about the recording of both the common stock and the preferred stock, and I will also be talking about the corporate capital, where I will be touching on the paid-in capital, the retained earnings and all. So hope to see you soon, students. Thank you so much.